Hi there, Deven. Good to have you on board. Why don't we start out by talking about what's happening in the pharma space, in particular, all the bids now that are trickling in for Cipla. At first, it was just a clutch of private equity investors, and Torrent Pharma was the front runner. We now understand that Bain has dialed Dr. Reddy's to team up for a joint bid for Cipla. Just going by what the company has built over the last many years and the strong legacy and healthy foundation, what do you think would be the right suitor for Cipla?
Yeah, good morning. Well, I think on one side, Cipla continues to expand into different territories, and that's fundamentally very important. The recent acquisition, I think, that they have done on the OTC side in South Africa is suggesting that the company is basically creating the deeper roots into different territories in which they are operating. In pharma business, having got the clearances from different countries, regulators to operate in those countries, I think that becomes a premium item as far as I think their company's business model goes. And Cipla does have the different clearances in different parts of the world, particularly in US and Africa and other parts of the world. So, in my viewpoint, I think the any suitor, whoever the name I think which comes up, definitely I think would like to see the value addition coming into them due to this particular clearances that they have got. Currently, the valuations which is being talked about is about 4 times the top line, which is not sounding that expensive. I think that is something which probably I think the valuation at which the company might end up striking some deal with some of the global players when they see the synergy. Whether I think the MNC players would find the synergy at this point of time or the local players would find the synergy with Cipla at this point of time, little hard to predict. I think given the kind of the close proximity in which I think various territories are controlled by respective companies. So from that perspective, one could not give an immediate answer. But yes, I think the names which are worthy definitely are having the largest market size, the market capitalization, which is asking them to look at company like Cipla, which is fundamentally remaining a very strong story. So I think one will have to wait and see how the inorganic path travels. But the fact remains that I think the synergy would work at the best when I think you have the approach which is basically complementary to each other.
Okay, so the valuation and all look reasonable as of now, but let's see who really comes as the buyer as far as Cipla's is concerned. But Deven, what about Raymond? Today, of course, we have Jeffries coming out with a buy note initiation. Motilal Oswal is quite excited, and both of them have pegged a target price of 2,600 on the stock. That after the massive re-rating Raymond has seen already, because of course it's real estate business as well as its traditional textile business. Do you really believe that Raymond has the triggers in place for another re-rating of sorts?
So, Anisha, without going into I think too much detail on this particular side, I think for the re-rating, I believe that the company has taken decent amount of I think actions on the corrective side of the business and the strategy thereon. Be it in the real estate space, be it in the textile space, branding space, I think everywhere probably I think they've been taking corrective actions. And that is something which is sounding more positive. Since we don't have the coverage on the company, I would refrain from putting across any view on the valuation at this point of time. But I do believe that I think this corrective strategy, which is in public domain, of course, I think is sounding more reassuring than ever before as far as Raymond is concerned.
A discussion with Deven Choksey as well. Deven, what are the other verticals that you're watching out for? Railways, of course, is one space which is seeing a very strong momentum. But would you still be a buyer? And if yes, which are the names that come to mind?
So I think essentially it means that I think when you have the capital goods companies participating into the infrastructure sector, the ultimately the beneficiaries would be the last mile. That is the companies which are producing the metals, and the metal commodity remains, I think, absolutely a convincing story hereafter. On one side, we had in the global market the situation of slowdown and China dumping the metals, I think particularly ferrous, non-ferrous both. And on the other side, country like India, which is basically already moving in the path of $1.3 trillion infrastructure spending in 10 years' time. So every year, successive year, I think they have been increasing the allocation towards spending on infrastructure, which does mean that I think the infrastructure spaces like railways particularly would get benefit. And apart from that, the many other areas, including I think in the defense, etc., where the company is striking distinctly higher amount of growth strategy, by replacing the import, I think, with the domestic production. So this means a good news for the metal as a commodity because as I see it, the metal as a commodity would probably have relatively a longer bull run going forward from now. Up till now, I think this particular space have been troubled because of the input cost, I think, which have been fluctuating very badly, I think, in given period. Now, in this kind of situation, when the alternate energy is being talked about, and most of the companies are basically switching over to even the subjects like green hydrogen, in my or even for that matter gray hydrogen, even if they have to I think get into, they still have relatively better ability to control the input cost, which is energy cost, and that remains more than 50% for metal commodity. So in my viewpoint, given the control on the input cost and given the kind of fact that I think there is a demand scenario emerging stronger, structurally metal as a space I think would remain relatively more stronger going forward. And that's where instead of buying the expensive railway stocks, I would prefer to buy into the commodity place like the steel at this point of time, where probably I think you may have relatively better returns to talk about going forward.
Okay, and let's take a look at the 1 month return for BHEL from about 96 rupees where it started off last month. 140 rupees is what it's knocking at right now, and Anisha actually sends the latest notes, steam blowing again, and all of the brokerages as well seem to be giving a thumbs up. Deven, your take?
Well, I think no arguments on this particular space, largely because of the fact that continuously the government's infrastructure spending is resulting into higher order inflow for most of the capital goods companies. Up till now, the public sector enterprises have been languishing in the market because of variety of reasons, inadequate capacity utilization included into it. Now, I think given the kind of order release that the government is continuously doing in this year's budget, I think they've provided for 10 lakh crores, I think, for investment to infrastructure. Uh, and believe that I think this is the resultant factor for most of the capital goods companies who are basically beneficiary of this situation. They'll definitely, I think, augurs well. They've been systematically accounting for a higher amount of order book positions coming in largely from the power sector, including the hydrogen power. And that is where probably I think we are seeing the better visibility of results going forward in coming 1 or 2 years. Market is definitely running little faster compared to the actual results which are coming up, but that's typically because of the fact that the stocks have remained suppressed, I think, for a longer period of time. And now probably I think they are entering into a space where the larger amount of business is being talked about. So yes, I think would remain selectively positive into some of the public sector companies which are largely contributing to the infrastructure related activities.
The number on your screen about the loans, what Paytm has distributed, I think is the most important number because it's not the UPI transaction. What really matters for a stock like Paytm now is that at what level are they able to grow their loan book, because that is where I think the spreads in the real business I think is the strongest for them. What a comeback year it's been for Paytm. I never saw that coming. Zomato, I guess everybody saw that kind of move coming. Nykaa, nobody was bearish on Nykaa at 2020 in 2021. But when excesses and when the market opinions they change, Nykaa has really gone the other way this year. It's been a comeback year for fintech and consumer tech, but Nykaa has just gone absolutely other way in terms of market. They've got some interesting data, and this interesting data is about expensive stocks, something what we were discussing in the morning. And if the data is ready, there you go. Look at some of the expensive stocks here. I'm not saying the stocks are bad, but I'm just simply putting perspective here in terms of P multiple. Genus Power, Zentech, Electra Green, Responsive Industries, just random assortment of stocks where P multiples are high. Now let's look at history, what history has told us. Market, they say that history may not repeat itself, but it certainly rhymes. Stay on this one. Now, exactly a year ago, Nykaa had hit a P multiple of 100 plus. TeamLease was at a P multiple of 100 plus. VMart 100 plus. Suntech 100 plus. Avenue Supermart 100 plus. And what's happened when they hit P multiples of 100? It's a very large basket I'm trying to pick up here. And we're using 100 just as a benchmark. These stocks have given negative returns. So Deven Choksey, when stocks they give negative, when they hit P multiples of 100 plus, they are unlikely to give good returns in the next 2 or 3 years. Are we reaching that in case of some, some defense stocks, some EMS stocks, some even railway stocks now?
Yes, I think I would be extremely careful about, I think, some of these companies and their valuations. The market is completely buying into the stories and they are probably ignoring the valuations at this point of time. Probably, I think the premium valuations that they've given does mean that I think they are factoring 100% plus kind of a growth year after year for next 3 to 5 years into these companies, which is not the reality. In my viewpoint, I think most of these companies, I think, which are basically being looked at, particularly in the defense space, and including some of them in the railway space also, they would have the tendency to grow at the best, I think, between 20 to 25%, and not beyond that on a cumulative basis for next 3 years, if that much of visibility is available. I don't think that I think one is justified in giving very huge fee, I think, to these companies. Time and again, we have seen that I think whenever the premium valuations have been given, subsequent period of time, 3 years to 4 years, I think would probably remain sideways for many of the businesses and the companies in the stock market. So that is one area where one would remain extremely watchful. One would not participate into the kind of a mad rush to buy into the business. Maybe any corrective downside, like what we saw in the beginning of this calendar year in February and March, you had a significant amount of corrections in the market, particularly in the mid cap and small cap stocks. 50 to 60% of values were eroded. That is a time when probably you buy into some of these companies which have high potential, and when they come down on valuation, that is a better time to buy into. So we are watchful, but we are not participating into this particular space. Beyond whatever we are holding, we continue to hold and book some profits everywhere it is possible.
There's a very interesting.
That because today Jeffries has also written a note saying that the power demand trends is driving the rally, but one needs to be very, very selective about it because the power demand has outpaced the availability for now. But they say that NTPC, Power Grid as well as JSW Energy are their top picks. However, they maintain the underperformed rating on Tata Power and IEX, given the fact we have seen a massive run up there. Which are your top bets, Deven?
So I think we continue to like Tata Power, and I think even though the price has recovered from lows in recent times, I think the company's strategy sounds, I think, quite convincing at this point of time. Uh, they have a balanced portfolio with the rooftop solar, with the distribution of what you call, I think, the power for the electric vehicles, and at the same time, I think the conventional power. I think in each of these spaces, I think the company has a balanced portfolio that I believe I think is going to augur well. And in my viewpoint, the charging business of power, I think, is again, I think, reassuring the fact that I think the company is basically going into a right direction where the demand is likely to grow faster. Though in recent times, I think the stock has moved up. I think I still see the headroom available for this particular company. So we continue to like quality business in Tata Power at this point of time. Having said that, I think the NTPC could also remain relatively a stronger play, largely because of the volume increase. However, the fact remains that I think you are not likely to see a very quantum jump, and that's where probably I think one will have to be mindful. Yes, I think previous year's problem about the input cost versus current year, I think is relatively better, feeling better for this company. So maybe I think you are likely to see a slight improvement into the price or the re-rating in the valuation, as I want to put it across in this particular case too.
For the outlook is when it comes to NBFCs, Deven, given that there are some tailwinds ahead, which is it or which are the stocks within this space that you would like to look at closely?
So the best of the lot definitely remains at this point of time, like Bajaj Finance, and I think second one will be Poonawalla. I think both these companies have distinctly clear strategy as far as I think their execution is concerned. Be it in the area of the retail financing or be it in the area of SME lending or even for that matter housing finance, which Bajaj Finance operates as a separate portfolio company. So they remained, I think, distinctly clear about I think their execution strategy. But the Geo Financial Services is promising to be, I think, a much bigger entity going forward. And that's where I think the larger amount of focus and the allocation of money is happening from our side into our portfolio than clients' portfolios. We believe that this is one area where probably I think given the size of network that the company has, given the kind of customers that the company has, I would think that I think they would be in a much better position to ramp up the operation and scale it to a level at which I think most of the peers have taken years. I think this company could take that route in next 2 to 3 years time, given that kind of a possibility that they have. So in this space, I think Geo Financials, I think where the other verticals are also equally, I think more promising, like insurance vertical, AMC vertical, and of course, I think this NBFC vertical. I think we believe that JFS would be relatively a better choice to make in a given situation to buy into the NBFC.
Let you go then, Deven. Good to have you on board
Thank you.
as always. Thanks very much for sharing with us your market outlook. What is the pre-open rate indicator?